I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Bank of America dropped a bombshell. And when you hear what they just said, it will leave you outright speechless that this could even come out of the mouth of one of the biggest commercial banks in this country. Plus, we mentioned 2 days ago that the unthinkable could happen today. We have the report now, and it left markets completely shocked. We're going to show you the truth behind this report and why it's the last of the good ones. And if you're wondering what we're doing in Australia today, well, if you think China's property bubble is bad, wait till you see what's going on in Australia. And with that, let's go to Bloomberg, where we picked today's story up with a headline. The RBA says share of borrowers in early financial stress is growing. Now, this is not a headline you want to hear after a central bank aggressively raises rates to curb inflation. You want to hear that, hey, borrowers are doing okay. In fact, they're being able to absorb these higher rates, and we're experiencing what we believe is a soft landing. But as we know, when central bankers invert yield curves and money curves, it's only a matter of time before the entire economy, and in this case, because we had a globally synchronized tightening machine, it's going to cause the entire global economy to seize at once. And what we're seeing is some early signs of that now in Australia. But wait till you see what's going on with their property market. A small but rising share of borrowers, notably just small, are on the cusp or in early stages of financial stress. This coming from the Reserve Bank of Australia in its recent financial stability review. It pointed out that the share of borrowers falling behind on mortgage payments has, quote, begun to pick up from a low level. And this is what you would expect following an aggressive amount of fiscal and monetary stimulus. You note the borrowers that still have some money, but as they run out, as the machine of the global economy starts to slow down, we know there is never enough money to pay on all the debts. It's just a matter, we need commercial banks to continue lending, creating new money into the economy, have that money multiply through the economy, and then next thing you know, we can sustain all the debt and the growth. But in the case where we're curbing the creation of new money, the signs that we're looking for is people having payment stress, entering delinquency, filing bankruptcies, and we're seeing those signs here in Australia, and it's not a good thing. The report comes as RBA's most aggressive tightening cycle in more than 3 decades has raised concerns over the outlook for Australia's heavily indebted households. Well, there's never a good set of words when you're going into a financial crisis at a time when a large chunk of loans fixed at record low rates during the depth of the pandemic come up for renewal. Now, keep in mind, unlike here in America, where a lot of people will get a fixed rate mortgage and perhaps refi it if rates go down, well, in Australia, doing variable rate loans was really popular. And if you're thinking, wait a minute, I've heard this story before, and it's what kicked off the global financial crisis, well, you got it right. It's coming again. There are also risks for Australian lenders who compete intensely in the vast mortgage market. Of course, that means that they know their borrowers are going to default, but no surprise, because Friday's report showed that high inflation and interest rates have reduced most households' spare cash. Well, that's obvious, though the majority have been able to adjust their finances as required. And this is one of the things that we've been talking about on the show on a regular basis. You hear it right now, including by restraining discretionary consumption, tapping their stock of savings, or boosting hours worked. The key part there is reducing their discretionary spending. And as more and more people around the world are forced to do that, it means those jobs in the discretionary space, they're going to start to go away. Those people are going to hit the unemployment line, their income's going to drop, and in turn their discretionary spending is going to fall, and then you start to create a feedback loop that starts to ripple through the global economy. Overall, Australian banks are in strong positions to raise provisions and absorb losses if economic conditions worsen more than expected. Of course, if you believe that, the very low share of borrowers and negative equity on their loans further protects banks against credit losses. Now, I don't know about you, but I don't believe for a minute that around the world that all these banks are as good a shape as the central bankers say. They always say this going into a tightening cycle. They always say this before a recession. I'd love to know what you think. Do you think the Australian banks are immune? Because we know the U.S., small and mid-sized regional banks are insolvent. The only question is around the world, how many are in dire shape? But get this, they're noting that, hey, as long as asset values are up, Well, we all know that's going to change. But weigh into the comments. Love to know what you think about the health of the global banking system, because now we turn to Fed's Daily. She says a rise in bond yields may mean the Fed can stay on hold. Now, I wanted to look at this. I wanted to look at what she said going into today's non-farm payroll report, which we'll get to, and then wait till you see what Bank of America had to say after all of this. It will just make no sense to you. But I want you to see that central bankers are nervous. They're going to try to appear very confident that finally the market's reacting. But what I want you to understand is, going back to the last FOMC meeting, Powell was a bit nervous that they may have gone too far, very close to that. That's what they're getting worried about. Let's see what she had to say. If we continue to see a cooling labor market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. So this is what she's saying here is, look, finally, interest rates went up. We've been telling you rates need to go higher, and if you won't let them, we're going to keep raising them. And finally, what happened? Traders, we know hedge funds aggressively came in and were shorting the long bond, and boy, that made central bankers really happy. And with the rise in long-term rates in recent weeks, here we go, the need for us to take further action is diminished because financial markets are already moving in the direction and they've done the work. She said there still are real risks to inflation's march downward, which we're going to look at in a moment, because this is what they've wanted. They've wanted long-term rates to go up. They were frustrated they couldn't get them. And now that they're moving up, perhaps too quickly for what they really want, there's starting to be some concern here that maybe they went too far, or maybe they shouldn't go any further, because the Fed believes that there's a sweet spot of rates. There's a range. And if they go one notch too high, they can break the whole system. What they don't know is even how the system works to begin with. But Daly's right here about what the effects are of inflation. Let's take a look. Here we have the total non-farm payroll report against the consumer price index as shown in blue. And what do we know? That in, of course, when consumer prices decelerate, the typical thing we see throughout history, and we see it multiple times, and I didn't even color in all of them, we note that non-farm payroll growth slows and then goes negative. And this happens repeatedly, except during the 1970s into the 1980s. But every time after that. Now, I've cut off the pandemic part just so we can see the chart, but what this suggests, and it's a case that we've been making, as inflation comes down, it's really a sign of demand from the consumer. And as that goes down, well, you don't need as many jobs created, which is really interesting considering what we saw in the jobs report today. But of course, as you'll see in a little bit, we're going to talk about the truth behind this report and why it's a one-off. If the deceleration of growth and inflation stall, activity begins to reaccelerate, or financial conditions reverse some of this tightening and loosen too much, we can react to those data and raise rates further until we're confident that monetary policy is sufficiently restrictive to compete the job. We need to keep an open mind and have optionality, and that's the thing. Their open mind here is getting a bit of worry because they're starting to think that maybe they went too far. You're getting some one-off data points here that suggest that perhaps everything's okay, but we're getting a lot of other data points that saying there is a broad slowdown in the economy. But if the Fed does continue to hike, well, at least one thing the markets seem to agree on is the dollar goes higher, and so should your trading account. Because you should have some optionality too when it comes to trading, and we've got two reports that will change everything about how you trade. This is what our most successful traders are doing. Here's the dollar. This is UUP. I want to show you. Back here, our report said this is when you want to buy. And then if you did, you'd be up 5.9% right now, while many people are watching the equity market drop. Here you can see going back to our July 25th report. What did we see? We told our subscribers, watch this, the dollar's massive short. Everybody thought it was going down. We said, wait till it reverses. Here you see the reversal, and then confirming the following day on our Momentum Timer Pro report. Mind you, you can still get the first month free, but there's only a limited number of those left. Here you see the one daily buy signal. You have the two tandem reports, and it changes again how you trade. There's links in the description below, but remember, Momentum Timer Pro, $20. You can lock it in for life, and there's 1 month free, but there's only so many free month coupons left. Get it before it's gone. But when you pair these together and you understand how the economy is working, it will again change the way you trade and make you very successful. Fed will lean toward another rate hike after the blowout payrolls, let's take a look here, because non-farm payrolls increased a whopping 336,000 last month, which nobody saw coming. Not even the best of the estimates said that, after sizable upward revisions to the two prior months. The unemployment rate even held steady at 3.8, and wages rose at a modest pace. This will keep the Fed very guarded and very much concerned about upside risk, because this plays into their concerns about reacceleration in the economy. Now, the question you should be asking is, where did all these jobs come from that ADP missed, that we're not seeing really a whole lot of in the weekly unemployment claims? Now, remember, as we go into the holiday season, what do companies usually like to hire? Well, they like to hire a lot of seasonal employees. And a lot of those are part-time. So what we're going to see is some seasonality effect here of a bunch of part-time jobs coming into play. It's what now happens afterwards. And we're making the case, well, this one report doesn't matter, and nor do the following revisions, because the trend going forward should be for a slowing in payroll growth. At the time, we know the Fed still got 2 meetings left to make a decision. And here's the evidence. We take a look at average weekly hours, this of production and non-supervisory employees, and you can see that while wage growth is still decent, we'll look at that in a moment, the amount of hours worked continues to slow down at a trend that is historically the case, where we know is about where we should be heading into a recession. And here we can see average hourly earnings. Well, they've slowed down to around 4.3%. If you said, wait a minute, this chart somewhat looks like the consumer price index, well, there's a good reason for that, because as consumers have less money to spend, well, they spend less money, and that means demand comes down and consumer price growth slows as well. So here we can see that, again, wages still growing at a decent clip, but that's not going to last a whole lot longer. So when we start to look at this against the non-farm payroll report, the question you should be asking is, does total compensation, which is average weekly hours multiplied by average hourly earnings, that's shown in red, lead the non-farm payroll report, or is it the opposite? But here's what we can say is, you notice the two are in sync over and over again. This was the 70s into the 80s. You go in the early 90s, and how about this, the dot-com bubble? What happened? We know total compensation slows, then payrolls follow. It happens again in the global financial crisis. And again, I had to cut off the current data, but we're seeing that effect now. Again, this is just because of the pandemic's effect on the non-farm payroll report. We can see one or the regular data. I can't get them all in the same chart. But so now let's look at total compensation together, because what I want you to see is we're definitely seeing a marked slowdown. So where did that 336,000 jobs report come from? Well, you notice there's a blip here in the trend that we don't tend to see too often heading to recessions. And notably, there's most likely this trend higher here where employers look to add. But notably, broadly speaking, we see this is headed much lower. And it certainly shows a strong labor market, but the pace of wage gains has been slowing. We said this will happen. This leaves the door open to another rate hike by the Fed. It's a tough balance between subdued inflation pressures and strong growth. And the simple reason employers can't give out more raises is because price growth is slowing. If you want high wages, you got to have inflation. In this case, as inflation cools, so too does pay growth. And that means it creates, again, what we call a negative feedback loop here, where as wages slow, people spend less, which turns into less consumption, prices come down, wage growth slows, and rinse repeat over and over again. And while the latest reports suggest economic momentum remains strong, central bankers will also be monitoring carefully inflation reports, including key consumer price report due next week on October 12th. And here we can note that inflation probably will pop a little bit next week, but likely too much. Here we know total compensation is shown in blue against the consumer price index, that in red, both on a year-over-year rate of change. And we can say again, this validates what we've been saying. Where spending or where incomes go, consumer prices follow. We have this, it's very evident. We see it throughout history, suggesting the path for consumer prices is likely lower. The question we're going to see is, how much did the energy shock of higher prices have the effect on broad discretionary spending? And that will be the determinant of where we see the CPI index head next week. My guess is it continues its trend lower. But now let's talk about Bank of America. They're absolutely shocking what they just said. I can't believe it. And based on everything you've just seen now, you probably won't either. Bonds to rally big in 2024 amid recession. This according to Bank of America's Hartnett. What is he, crazy? No one thinks bonds are going up except me. Once a recession being priced by bond and stock markets mutates into economic data, bonds rally big, and bonds should be the best performing asset class for the first half of 2024. This according to Hartnett. Now, you would not think that because everybody believes that inflation is now entrenched. It's going to be like the 1970s. Even the central bankers think it's coming back. And that means everyone's bought into interest rates are going to stay high, perhaps even go higher. He's saying, wait a minute, if bond rallies, that means interest rates are going down in a big way. Hartnett, who has been pessimistic on risk assets throughout the year, remains bearish for now amid the likelihood of an economic hard landing from higher interest rates. His team is, quote, impatiently waiting for capitulation selling and a recession or credit event to trigger bullish policy easing. Of course, we know that that means the Fed going back to zero. They've been there twice, so they'll be there a third time in a row. This question is when you see interest rates come down, will they still be inverted when the Fed's at zero? I think this time they will. The Fed will have to find a way to go negative, even though we know they have no mechanism to. That means QE will come back in a big way. But here we can see the issue with yield and what Hartnett's saying about is when we look at total compensation in blue, again, shown on a year-over-year rate of change. Notably, we now have the 10-year Treasury yield overlaid, that in red. This is one of the few times in history that you'll notice that as total compensation growth slows, the market thinks interest rates need to go higher. What you should see is interest rates go lower because as consumers have less money to spend, what do they need to maintain their spending habits? Higher or lower rates? It's obvious. They need lower rates. And that's why the market, by driving the interest rates higher, is actually doing the economy a disservice here, and why we believe it's going to hit a wall all at once. And that's why, as we started the show out by saying, I think this is the last of the good reports, and here's why. September jobs report may be the last good one before a sharp slowdown. We're saying the economy is going to hit a wall here. The September payroll report is backward looking. Well, of course, that's why central bankers like it. And since the September survey week, financial conditions have tightened sharply and auto strikes have escalated. This is true. We've noted that there's going to be a lot of effects going forward and into the holiday season. And here's the evidence, because as you see, we now have the net percentage of domestic banks tightening standards to firms of all sizes against total compensation in blue. And what do we know? That as banks tighten lending standards and create less money in the economy, total compensation goes down. The money's got to come from somewhere. It has to be created by the commercial banks. As you see here during the global financial crisis, when they're not creating it, wages grow down. We're seeing it happen again. The only difference is people don't believe that the commercial banks tightening lending standards even matters, and it does. We're saying with what's going on in the economy that rates at their current level are going to cause the banks to tighten standards even more, create even less money, and at one point it's all hitting a wall, and that means those non-farm payroll numbers that look good today are not going to look so good in the future. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.